In this chapter, we are going to get a little bit more technical and talk about candlesticks and open, high, low, close formula. First of all, what are the candlesticks? Candlesticks were invented by Japanese traders some 400 years ago, and they were using them originally to trade and negotiate rice prices. Fast forward 400 years in the digital era, we still use the same method. Candlestick is a visual depiction of a price movement within a certain time frame. It contains very important information for a trader to make a judgment and identify the opportunities to open position buy or sell. When you look at the technical aspects of candle, first of all, this is a body of the candle. This candle is bullish for buy. The one on the right is bearish for sell. The tips, top and bottom, are upper and lower wick, or you can call them shadows as well. Okay? Now, if I was to identify open, high, low, and close of the price, for bullish, open would be here, high would be right here on the top, low and close. For bearish, the price opens at the top of the structure. This is the high, this is the low, and this is the close. Makes sense? Let's have a look at the more specific example. Bullish candle. Okay? Open, high, low, and close. If I was to use these points as point of reference to draw a line, it would go along like this. Open, low, high, and close. And then subsequently for the bearish candle, open, high, low, and close. Open, high, low, and close. Make sense? Let's have a look at the real life chart example to make it a little bit easier and practice. First of all, we have a gold chart on TradingView on a 4-hour time frame. What this means is that every single candle that you see contains the information of a price movement within the last 4 hours. This is 4 hours, this is 4 hours, this is 4 hours. Every single candle here that you see is a 4 hours time frame. Okay? Let's pick one of the candles. I can see a bearish candle over here. Now, where is the OHLC? Price opens here, hits the high, the top of the wick, this is low, and then closes below, which is close. Therefore, open, low, high, close. This is a bearish candle too. Open, high on the top of that wick, low, and close. If I was to draw a line based on these points, it would go open, high, low, and close. All right? Now, let's take the same screenshot and let's have a look, or actually let's have a look at the example a little bit further. Let's look for the bullish candle. Okay? All right, let's take a screenshot. Now, this is a bullish candle. This is actually the last bullish candle before the big drop, correct? Let's have a look at the open, high, low, and close. Open, low, high, and close. Open, low, high, and close. If I was to draw a line, it would go like this. Open, low, high, and close. Correct? If you get a good understanding of how these candles work, you're halfway there. We will be discussing this more in webinars and in further chapters as well. But this is a basic that it is important for a new trader to understand how the candles actually operate, how they work. So let's do a quick summary, okay? What are the candlesticks? What do they do? they pull the data of all the prices and transactions. All the people trading, they making transactions, and all the information from these transactions is encrypted within the bodies and wicks of these candles. There are many time frames, anything from a monthly time frame up to a 1 minute time frame for the retail trader looking at the trading view. The important part to note, the higher the time frame, the more information is within one single candle. So I would say the higher the time frame, the more solid that candle is, the more stable, because you have a lot of transaction accumulated within that time frame. Now, the next thing, MetaTrader, when you are trading, has a time frame spectrum of monthly, weekly, daily, 4 hours, 1 hour, 30 minutes, 15, all the way up to 1 minute. TradingView offers you a little bit more options, like, you have the time frames in between 2 hours or 45 minutes. And professional trading and robots, like the mentioned in chapter 1, Reuters machines, they have such specified time frames up to seconds and milliseconds in order to execute the trades as fast as possible. The most important part is understanding open, high, low, close formula is really essential to be able to find potential reversal patterns. About reversal patterns we'll be discussing on webinars and further chapters, but all in all, the most important part for you is to understand that the open, high, low, and close is the key to understanding how the candlesticks operate. Let's move on to chapter 4.